on and talk about Sobha. Now, Sobha developers reported a good set of Q1 earnings. The numbers came out 2 days back, but we already had a sense of the numbers given the Q1 operational numbers. It's the fifth consecutive quarter of record high bookings. Pre-sales jumped up by 28% on a year-on-year basis, and realizations have improved very sharply, A, due to price hikes, and 2, a change in the product mix. The company is now selling far more luxury homes, which has helped boost their realizations. To discuss their Q1 performance, we're joined by Jagadish Nangineni, the MD of Sobha. Thank you very much, sir, for joining in. Let me talk about your high-end segment. The way your product mix is changing towards premium is very staggering. It's happening at a phenomenally fast pace. I believe your high-end segment is now nearly half of your sales, and this number was about in the mid-30s in FY23. Can you tell us the growth that we're seeing in the high-end segment? What will be the split going forward? And what are the margins that you enjoy on the high-end segment, the luxury space?
Thank you. Thank you for having me on your show. You're right. We had the 8th straight quarter in which we did sales better than the previous quarter, and which is in this quarter specifically, it's even better because we didn't have any new launches. Our teams across the country have done a phenomenal job at it. The performance especially is due to a combination of two factors. One is our geographical diversification that we had, where we have inventory in 11 cities. And second is due to the change in the mix, like you have observed, from the mid-luxury to a slightly high-end luxury segment. This change, and hence due to this, we have crossed for the first time 10,000 rupees average price realization mark in this quarter. The mix is also because we have seen the trend of larger home sales early on, and we could change our mix in our own design, and that has helped us. And second is also you have seen that more than 3 crores ticket size, which is contributing 37% of our sale in this quarter. About 2 years ago, that was less than 5%. So that change in the mix has worked out really well for us.
All right. Hi, Jagadish. Good morning. Well, you must be feeling good, right? Good traction on ground. Inventory levels are lower. Launches are being picked up. But as you said, in the first quarter, there were no new launches. But do you think, going by what you have done in the first quarter, you'll be able to exceed the 15-20% pre-sales growth that earlier you were guiding for FY24?
Well, we aim for the best numbers, Nigel. But like we had been anticipating good set of launches this financial year, and hence we thought we could do those numbers. Some of the launches are slightly delayed now. So, but still we would try to achieve those numbers. But it is all dependent on, like I had mentioned in the investor call as well. It is all dependent on our ability to do new launches.
Okay, so would that mean that you can, deliver on your guidance of 15 to 20% pre-sales growth? I think that's the guidance for this year. Are you on track, or given the traction that you're seeing so far in the first quarter, you think you can maybe even do better than 20%?
I think we are mostly on track for trying to do that. It's very tough to predict for the next 3 quarters, given the nature of the launches and the timelines for it.
Last year, I think your sales were 5.6 million square feet. In the call yesterday, you've laid out a medium-term ambition of 8 million square feet. What's medium term? Do you think it will take you 2 years? Do you think it will take you 3 years? Or maybe even longer?
So we have been seeing, we are in the 8th straight quarter of increased sales, and we did about 5.65 million square feet last year. This year we would like to better it, and we would like to be a consistent performer with balance, with where we have a balance of growth and profitability. Given that, and also we are building up our pipeline inventory to achieve these numbers. from a timeline perspective, I think it's a little too early to predict as when those would happen. But I'm sure we will reach there. When I say medium term, maybe 4 to 5 years.
Okay. All right, Jagadish. For a real estate developer, and from the time that I've been looking at it for the last many years, is sales is a very good friend, but debt becomes an enemy, and you have kept that enemy far away from yourself. I think your debt number as we speak is at 9-year lows. Could you tell us what is the trajectory on the debt front from here on? You'll require some funding for new projects as well. So where does this debt number move up? Do the promoter entity have any kind of intent to pump more money into the company?
Yes, Nigel, we have a very laser sharp focus on our cash flow generation, and due to which we have the 11th straight quarter of debt reduction and net cash flow generation. We are at almost half the levels of our peak debt, which was in FY21. And this has really helped us in improving and financial structure of the company. And we believe going forward also we have very good pipeline of these the inventory. And as a company, we have been in the business for more than 28 years, and we think that we are very well capitalized, and we have done investments in the past, which we can reap those benefits in the coming years. And due to those cash flows, those we should be able to use to fuel the growth in the future, and also keep a cap or reduce the debt further.
Okay, so can you sort of lay out that roadmap for us? I was just going to get to that point actually. What is a debt equity ratio that you'd like to maintain on a going basis? You said that there's more cash flow coming in and you could reduce debt. So what number could it go down to? What is a comfortable debt equity position? And then what about funding for future growth? I mean, whether it's buying land and your other investments as you're looking at the launch pipeline, how will you sort of look at the cash and the investment for that?
Well, like I just mentioned, the cash flow that we are visualizing from the new inventory that will come in, that should largely fund the growth for the future, and hence our ability to manage the cash flow and keep the debt at these levels should be fairly good.
Very quickly, Jagadish, in Q1, the blended realization went up by 25%. Partly it's on account of the fact the company is selling more premium projects. But you also undertook a price hike, 17% price hike in Bengaluru, and Gurugram prices, I believe, went up by 40%. Do you think, the company will be upping prices again in Q2 or Q3? What's the view on price hikes from here on, and in which markets?
We are not here. Actually, stable pricing and incremental inflationary-led pricing is what we are happy with. Like I said, in the first stage of price increases had occurred in post-COVID, when the costs for the construction have significantly increased, and across board the industry had to take price hikes. And this mix has come in wherein we had to increase we could manage better pricing because of the mix in the projects. We are not necessarily seeing a price hikes from here on, but at the same time, due to the mix in the change in the nature of the projects, if the average realization improves or remains steady, we'll be very happy with it.
Okay, got that, Jagadish. We will leave it on that note. That is Sobha at the end of the first quarter.